Hi, it's Jeffrey Cohen, Chicago Quantum. How are you? It's Friday. It's quadruple witching hour, which means not only do individual stock options expire, but other types of options and futures also expire. And so there's many things going on in the market today. It is a very high risk day. And what we noticed was the market opened lower and it just continued lower. Now, we ran our model last night, the Chicago Quantum Net Score, and I've got it right over there. I'm happy to show you the spreadsheet and a sample of the report. But actually, before I get to that, I just wanted to talk about a few things. So, we noticed a few things about the market. Let's see if I can find those. The first is that this week, people feel like maybe it's a really bad week, but it's only down 2.3 to 2.9%. The different exchanges or different, market exchanges, or also the financials. And so, not a great week, not a terrible week. We've noticed the dollar, it's maybe it's done. Maybe the dollar strength is done. But then we see the Chinese renminbi or the yuan at almost 7. And the question is, will it go from 6.9865 to 7? I don't know. I think that's interesting, right? The dollar is strong, but it's not getting much stronger. So, QQQ is weak. You see how it just fell right at the beginning? I actually can show you where I get that chart from. It's called FinViz, finviz.com. And you see along the top, you've got the Dow, the NASDAQ, the S&P. You've also got a heat map, you've got major news, and then you got your ups and your downs. What I find interesting about today is that Avaya fell 63%. So Avaya is a stock that we shorted. It was actually the first stock we shorted in 2021. 2022. No, maybe it was this year. And so what happened was we had to, we were nervous, right? Not so good at shorting. But we called that this stock was dog meat. $3-4 a share, and it's now at 19 cents. So feeling pretty good about that call. It was based on fundamental analysis. It wasn't based on the chart. It was based on the company. So that's kind of how we like to invest our own money, is doing fundamental analysis. But our model, of course, is, I guess you'd call it technical analysis, quantitative analysis. But look at the S&P 500, right? It's less than a 1.0 relative volume versus other days. NASDAQ is right at 1. Dow is right at 1. But you see just pretty much a straight decline, like a gradual flattening decline. We've seen a lot of these types of days. It's rough. And then when you look at the stocks overall, you see there aren't very many, this is the S&P 500 today. There aren't a lot of bright spots. Adobe, Facebook, Netflix, T-Mobile, Newmont Mining, so gold, Freeport-McMoRan, so copper. Not a lot. Not a lot of excitement here. Charles Schwab Company, probably just because they're the Charles Schwab Company. They're actually our custodian that we outsource to for our clients. And so, interesting day. Not sure where it's going to head. I mean, earlier in the day, everything was down for the most part, every sector. So, let's take a look. The other thing I want to talk about is, in our model, we assume 11.1% capital return over the next year, plus a 1.4% dividend yield. So that's a 12.51% total return for the year. Now, what's interesting is the if we take a look at the spreadsheet, these are the individual stocks with the Chicago Quantum Net Score value. And so what I'm going to do So I'm going to hide all this. And I'm going to make the text much, much bigger so you can see. So it's nice, right? And so one of the first things I noticed was that the S&P 500, when you look at actuals, so the fact that it's gone down, dividend yield has gone up. It's 1.4967%. So it's actually 1.5%. That's pretty new finding. And so that would say here, we're going to shoot out a reply and say, quick update. The SPY has now historically yielded 1.5% over the past 253 trading days, and it's dividend divided by average closing price. This gives us a tiny bit of wiggle room in the 12.51% expected return forecast. Okay, good to know. No one's going to care about that, but that's just, for us, it's pretty interesting. Right, because you see the market is really low. I mean, American Express is down 3.25. We're going to look at a bubble chart, which is going to allow us to see this kind of big picture, to see what's up and down. And we're also not going to look at the very top of the chart. We're going to cut it off at 1%. And we're going to cut it off at the bottom at 6%. So let's just focus a little more where we want to focus. You see zeros up here. So we're like Oracle's at 0. Wynn is at 0, which is the casino. You see Ford is down almost 6%. CarMax, Tesla. Tesla's down almost 4.5%. Williams Company, APA, which is Apache, they're down quite a bit. Iron Mountain, Prologis, some other business-to-business type of firms are not doing very well. Some REITs. And then you have Accenture down almost 6%. And so you look at this and you think, okay, a lot going down. Not a lot going up, though. I got it, right? This is a downward day. But I will say this. The expected return of our model is also looking... No, I'm not going to say that. It's hard to know, right, whether it's going to be okay or not. Saying it's going to go up 11% is still a very aggressive forecast by the end of next year, because everyone's calling a recession. So here we go. Here's the big news we saw. U.S. recession risk in 2023. Got it. Understand, Jeff. Number 2, China COVID impacts this winter. Looks very large, actually. Looks like we're going to have a lot of COVID impact in China. Rising interest rates globally, except for Asia. So Japan, China, not so much, but the rest of the world, for sure. And then stock price volatility has spiked, but has also plateaued. It is now flat. That's interesting, because what that says is that it's not becoming more and more risky. Now it's kind of like inflation. It peaks. Volatility peaked. So that's interesting for us. I mean, there's other stuff to share, but this is the big one. Oh, PMI. The Purchasing Managers Index is down. Not helpful. See, down here, right around 46. It's like 44.6, which is below 45. November it was 46, so it's not great. It's a recession signal. Other thing I wanted to talk about, the COVID thing, which I fixated on very much so this morning, is the R number. So the R number is a best estimate of how many people get infected by each person who has the virus. Now, the US, I think, peaked at 10. If you had the virus, you didn't see that many people. And so on average, if one person had it in a town, they gave it to 10 people. So it spreads really fast. I think now we're at like 2 or 3, because if somebody gets COVID now, they kind of know it and they hide. And that's it. It's fine. In China, the R number is 16 during this most recent surge. That's a really high level of transmissibility, according to epidemiologist Ben Cowling. It means for every person that has it, let's say 2,000 people have it. So 2,000 times 16 is 32,000. Let's write that down. And then they have it. And those 32,000 people will infect, how do I do the math? 32,000 times 16 is 480,000. So 480,000 people catch it in a few days. It's 8 million people. There's only they're saying now 800 million people could be infected by the winter. It's just crazy numbers, right? So that's what it is. So I thought that was really bad, and I wanted to tell everyone about it. There's other stuff too. So what's interesting is John Kolovos from Macro Risk Advisors. He's the chief technical strategist. He said what he'd like to see is, let's stop the fall in stocks. Let's reduce stock volatility. What's interesting is we've peaked, but we haven't started to reduce yet. Once you reduce stock price volatility, then you can start to kind of hit a bottom in price. Stock volatility drives a reduction in the expected return forecast. I could say it one more time. It's maybe not that hard to explain. So if you have a stock and it's moving pretty smooth, you're willing to buy it. You want to hold on to it. You feel a little bit safer. But if you buy a stock, you see a stock and it moves up and down, up and down, up and down, you'll pay less for it because you're nervous. You're upset. You don't like it. People will often take a sure bet over a more risky bet with the same net present value. That's what it means to reduce stock price volatility. And we've noticed stock volatility is actually a little lower. You're not going to have any idea what I'm showing you, but let's try. The variance of the S&P 500, the spider, which is the ETF, is 2.3 times 10 to the negative 4. So, Jeffrey, how does that compare? 2.3 times 10 to the negative 4. How does that compare to what it's been? So you go to market information on our website. It's all free. Anyone can look at it. You don't have to be a high net worth individual, an institutional investor, accredited, any of that. You just look at the data. I do this because, first off, I love it when other people share really good technical data, and I want to give back. But I'm also hoping maybe somebody trips over the website and says, this is great. Somebody cares about, the price volatility of stocks. Oh, I love it. So they click on daily price volatility. They see stock price variance through December 7. They scroll on down, and they see the S&P 500 right there. And you see that price volatility actually was 1.2 in May times 10 to the negative 4. It's now 2.3. But looky here. It's been 2.3 for since November 10. That's a month, over a month, 5 weeks. So we've plateaued on our volatility. That's terrific. Sounds good, right? My guess is you're going to see the same thing let's look at stocks of companies that made a profit and look at what their volatility is. This is what I think about all the time. This is why people say my life can be very boring. I don't find this boring at all. So 2.5 times 10 to the negative 4 price volatility for 1,708 stocks held for a year evenly. That portfolio has a variance that is very, very similar to the S&P 500, but a little higher because the S&P 500 is market capitalization weighted, and that gives it a little extra advantage than our model, which is even weighted. And the reason is, let's say we were to pick 5 stocks we kind of like for our client. If you're going to give us $1, we're going to put 20 cents in each of the 5 stocks. It could be that if one of the stocks was Apple and one of the stocks was Bob's Your Uncle, you could end up with, out of 100, 45 or 50 cents going into Apple and a penny going into Bob's Your Uncle. Or 1 going to Bob's Your Uncle. So that's not how we want to do it. We want to have an even. So we probably give up 10% of our performance, theoretical maximum performance, by doing it even weighted. But we like it that way. We actually could, and we have experimented with using market capitalization. And in fact, we pull market capitalization data into our model so that we have it. All right, Jeff, so what's your point? So the point is, overall stock variance 2.5. If we look at the stocks that made a profit, right here, stocks of positive net income, you see it used to be 1.4 times 10 to the negative 4. We're at 2.5. And you'll see that we've been at 2.5 since November 4. We actually peaked right before Thanksgiving at 2.6, and we've come back down to 2.5. Feels like we're at a peak. It feels like we're at a price volatility peak. Now, if someone was actually managing my videos for me, they would do a little write-up that said, oh, Jeff's going to talk about stock price volatility, and isn't that interesting? And that would mean that no one would watch the video, which is probably what's going to happen anyway. But that's okay. This is what we do, and actually, it gives us hope. Hope of a brighter future for stocks, which is why we assume 12.5% expected return going into the future. We're okay with that. Now, if price volatility had continued to rise, in fact, go back to the data, in late November, I had actually lowered the expected return to 9%. 9% inclusive of dividends. So it was like 7.5 plus 1.5 because volatility was going through the roof and I didn't see any way out of it. And the more volatile you are, the more likely you are to crash. And you know what? Not okay with that. It feels like we are gently tiptoeing our way back from the edge of the crash abyss. It's not to say next week isn't a crazy week, but for right now, we're tiny steps away from the abyss. Love that. That's a bullish sign for stocks. First I've seen in a while. Let's just say that. What else is interesting? I thought I wasn't going to have anything to talk about. Let's think. Well, let's talk about... Man, it's just garbage. I don't want to talk about my stocks. They are completely garbage right now. Let's talk about banking. U.S. regional banking and the interest rates that drive it. So you can see the indices. The S&P 500 is actually down the most at 1.5%. NASDAQ 1.33, Russell 1.29. That's great. You see the dollar at 104. Now the dollar has been as high as 115. So the dollar has come down. Not to say it's crashed, but it's come down like 10%. TLT is the long bond. It's an ETF that tracks the value of the long bond, 108. Again, you've seen that as high as 150 when interest rates were much lower. So it's much, much lower. Mortgage-backed security, mutual funds, and then you have your banking indices. KBE is large banks, KRE is smaller banks, and those are down. And you see like the larger banks bid as high as 60, as low as 42. The small banks almost 80 to like 60, and you're kind of close to 60 now. So you're close to the bottom. Banks are tough when you go into a recession. And when they were holding a lot of loans and bonds and the interest rates have gone up. It's just really tough for banks. You see a lot of green, though, in the banks, which is surprising. Not all. More than half are red, but lower business activity. Okay. Banks don't like that. Banks like a lot of business activity. Let's look at money managers. Let's look at the people who invest in the stock market for us. Morgan Stanley, Schwab, Goldman Sachs. This is market capitalization ranked, at least the last time we looked. And you can see it's a pretty tough time right now. You look at BX, you look at Blackstone, that's not doing very well. But even like a Goldman Sachs or Morgan Stanley, I think there's risk in the market. There's risk in the companies that lend, that borrow, that make trading happen. B. Riley Financial. There's risk because they probably were recommending all the meme stocks that crashed. And there may not be as many IPOs and M&A and a lot of activity for them. Underwriting activity, new issues that they might like, that where they make money, right? So we look at retail, again, market cap weighted, Nike, TJ Maxx, Lululemon, Ross Stores, Walgreens, you name it. I don't know who you are. Is it? Oh, United Rentals. That's actually a good company. I like the company. I don't know if I like the stock, but I like the company. I always like the company. Ulta. And so you see this all red. You have to scroll down quite a bit to get to UAA. I think that's Under Armour Class A. Fine. That's a weird one. So yeah, you have to go a long way. So retail's down in the dumps. Coal. Mixed. Not bad. Crypto and miners. So the top is physical miners through here. And the bottom is going to be your crypto. So for physical miners, though, it's interesting. US Steel's up almost 5%. That's crazy talk. Cleveland Cliffs is flat. Steel Dynamics is down. Newmont Mining is up. FCX is up. But the big mineral producers that are needed for heavy industry and construction, they're down. Okay. Chips and semiconductors. The high beta group, the high beta crowd, the momentum crowd. Not doing so great. Mixed, but negative. So kind of like anywhere you go. Trucking, transport, logistics services down, all down. Quantum computer companies. Interestingly enough, D-Wave's doing okay. That's nice, but D-Wave is down 80%, so who's to say? You look at Rigetti. Rigetti broke through $1, and now it looks like it's trying to break. It's broken through 91 cents, and so that's tough. I mean, Rigetti is like in a free fall. Don't catch a falling knife. It was probably cheap at $5. At $4, it was cheaper. At $3, oh, what a deal. At $2, no way it could go lower. At $1.50, you were mortgaging your house. At $1.25, you're selling all your Bitcoin. At $1, you're like, it can't go any lower. It's $1. Darn it. Now it's 91 cents. You probably don't have anything else to sell. So, just wait. We look at business to business and business to consumer, right? Accenture, we know, is down 6%. I'm interested at Kyndryl, which is the IBM spinoff, is down 5%. DXC, which was CSC and EDS, outsourcing and IT services, down 3%. These stocks are down. Charter, Lumen, T, Comcast, Verizon, all down. T-Mobile's not doing badly. I'm not sure why that is, but T-Mobile seems to do well when the others do badly. Hewlett-Packard Enterprises is down. CDW, Dell, the HP company, Nintendo, IBM, Cisco, just the whole thing. So you look at the market and you think, all right, it's a bad day. Everything's being marked lower. It must be because interest rates went up. That would be like the only thing that makes sense. That or there's a recession risk. So let's take a look at interest rates. Well, the 30-year yield is up 2 basis points. The 10-year yield is up 2 basis points. The 5-year yield is down 2 basis points. The 13-week is down 5 basis points. So people aren't buying into the Fed, FOMC, raising policy rates to 4.25%, 4.5%. Because you take a look, and we can't even make 4.25% on a 13-week. Now, I do have a little cheat sheet here. I got another place to look for the 1 year and for the 1 month. We'll start with the 1 month because it's closest to policy rate. It's like a 4-week treasury bill. And that's 3.82. That is nowhere near 4.25 to 4.5. And so, okay. Just is what it is, right? The 1 year, though, look at that. That's even falling. So short rates are falling, long rates are rising. I don't know. Interesting. I'm not exactly sure what all this means. I think it means the dollar's going to fall because interest rates in the short end are going to fall. But again, no idea. It's just a lot of movement right now, and it could just be because it's Friday, it's afternoon, it's at 2:30 Eastern. You only got an hour and a half left to trade. And so that could be it. But I just find it very interesting that the short rates are down and the long rates are up, but they're only up slightly. And the short rates are down dramatically. 5 basis points for short rate is a major move versus 2 points on the long. So I think that's about all I'm going to show you here. I mean, maybe I should take a look at the model or whatever. Let's take a look at some other stuff, some other data. So I could explain just for a minute how our model works and how you charge. So what happens is if you want to buy our quantitative run up or down, it's a one-time purchase. You can either buy the Chicago Quantum Net Score up or the Chicago Quantum Net Score down. Now the up you'd use to build a long portfolio, the down you use to build a short portfolio. Typically the effects last about 20 trading days. When we run our fund, we run it every day and we balance on a daily basis. So you could buy it every day and manage your own money. For a small enough fund, it wouldn't make any sense. If you've got hundreds of millions of dollars, then God help you. Just go ahead and buy the runs as often as you want, manage your own fund. I think that's fine. We explain how you might build a fund. We explain technically how it works. We have a primary service, which is you get all these things. And then here's how it works. If you just wanted to buy a consulting work day, I'll even get on a plane if you want. And I'll work for you for a day. I'll explain everything and we'll talk and we'll do something. Make something happen. That's $1,500. I have a sale going on right now. It's $100 to buy the Chicago Quantum Net Score up or long analysis. $7,500 a week if you want me personally to code for you. Code the algorithm ideas that you might have into the model, or we could build our own little special thing. We can use Intrinio's data, and then eventually if you really like it, you can contract with Intrinio for data. We can actually resell the data. Not a huge profit provider for us, but it's important that you would have data and code and it would run, and we could even help you maintain it. Or you could buy a short analysis, which shows you stocks to avoid or to actually short for $100. Normally $750. We also will do an investment planning workshop. This is over a course of a week. We'll spend time with you. We'll sit down, we'll have meetings, and we'll write it up. And so we'll try to figure out what you need, what the right type of portfolio is for you, asset allocation, how much risk, and then if our fund would make sense for you, then we can build that in, and it may not. And then we have other ancillary services, right? And we also will focus on primary research. We could do investment research on a particular industry or company. Pretty good at that. And so this is where we're at. This is what we do. So let's take a look. First off, did the market move? Let's go back. Looks like it tried to recover. 38.40. It's down to 38.30. If I go to S&P 500, you see 38.30. I also have a NASDAQ book viewer that we can use. It's great. So it's funny, you look at the stocks that we have. We do not have Credit Suisse. We're actually thinking of taking a position. But it is in so much trouble that even with the 4 billion Swiss franc equity raise, I'm still not sure they survive. You got Corbis, you got Cullen/Frost, and you got Verizon. And you see Verizon's down 2.25% today, really taking it on the chin compared to the S&P 500 or even the Dow. Cullen/Frost is down 0.8%, so Cullen/Frost must be a very low beta stock. It doesn't move that much. It really doesn't. And then you got Corbis, which is one of those biotech stonks, because they don't have revenue. They lose money every quarter. They're going to run out of money in 2024. They have these great drug candidates. I'm not a drug expert. They seem really great, though. And so you buy and you pray. Now, on December 20, they're having a board meeting, a proxy meeting. I'm invited because I own enough shares that it's actually probably worth it to call in. And can hear what they're going to do. And my guess is they'll do a reverse split. They'll probably do like 30 to 1, 40 to 1, I don't know. Get the stock up to $3, $4, $5 a share, and then just pray for rain that it doesn't go back under $1 and I got to do it again. But no guarantee. This thing is so risky. So I got Corbis on the long side. I'm short Cullen/Frost. I got a tiny bit of Verizon calls. I actually have a lot of calls, but they're worthless. And so I think it's like $200 in calls. I think I paid probably 10 grand for the calls, and they're worth $200. So I'm down 99.8%. It happens, right? We're just going to hold on. Your January calls. You never know, right? Santa Claus can come. But I'm not worried about it, right? So, not bad. Down $1.04. So figure I have a share. One share. I made $1.04 today. Love it. I'm banking. I could probably buy some pretzels. So, it's good. Oh, wait. But Corbis fell. So if I have a bunch of shares, 1,000 shares, I just lost 26 cents per 1,000 shares. No, $2.60 for 1,000 shares. So I made $1 on Cullen/Frost. I lost $2.60 on Corbis. So no pretzels for you, Jeffrey. I've held these positions for so long, it's kind of painful. So we'll see what happens. But it's interesting to watch the S&P 500 to really kind of have it on your screen and try to figure out what it's doing. So if I look at a 5-minute, start with the 1-hour chart. And you see the thing, it comes down, it goes flat, it comes up again, it gapped up. I mean, there's hope. People have hope with the S&P 500. But then here it is, fell off a cliff, 40.40 down to 38.40. Just saying, it's 200 points, it's like 6%. You look at it 15 minutes, you're not feeling so hopeful. It's this gradual slide lower. You look over 5 minutes and you see, well, it actually dropped like a rock and it's been flat. You look at the 2-minute chart. I don't like the 1-minute chart. And you see, oh, on a 2-minute basis, this thing is like, it rides like a horse, right? It's up, it's down, it's up, it's down, it's flat, it's up, it's down, but that's only a 2-minute chart. So you don't really worry about it. But what's interesting is you see the MACD, you do get a little bit of movement. It did hit an RSI of 75 when it peaked up here to 38.43. Then it comes back down. So it's volatile minute by minute, but if you were to look day by day, I just plugged in by the day, and day by day it's actually more of a rise and fall kind of a story with, you're obviously in a bear market, so the question becomes, what are you waiting for, right? Look at this bear market. What are you waiting for? Well, what you're waiting for is that to close, those gaps to close. At least I am. I don't think this is a support resistance play. I think this is a neck, breaking the neck of a stock. And so I think you're looking at something like I know what some people will do is they'll draw it like this, like flat, and they'll say, oh, we're in a flat period, but I don't know that I see this. I just see it as a decline. It's just a decline. It's just a decline. And you're going to ride it lower. You're going to ride it lower until it finally figures out when it wants to stop. And so with interest rates rising, I don't have much hope. I think you're going to see some weakness in the S&P. And so you can watch it today. It's fine. You know what? We'll go back to the 2-minute chart and we'll just see what happens. Let it sit there. So other tweets that I might have made that were important. I did talk to you about the sale. We're down to $100 for the runs. I was expecting the phone to be ringing off the hook. No sales. No sales. Somebody buy a run, pay $100. Let's go. I want to make some friends here, right? There's a little bit on COVID, but that's like kind of rough. I don't really want to talk about Chinese COVID. I don't like it. I don't want to talk about it. I could talk about how cryptocurrencies stink, but that's, why don't you just beat a dead horse? This one was interesting. Which US regional banks trade above 3 times price to book value? And then I gave the stocks. And the way I did that was I actually looked at something on Yahoo Finance. So what is this? I don't want to reply with that. That's stupid. I don't even know what that is, right? So, German bank. Yeah, let's go. Let's look at those. Sometimes I get a little confused with the names, so it's good to. GABC. No, that's German American Bank. I think this is different. Yeah, this is GCBC. Let's see if they made my list. They did not make my list. That's a new stock. That's cool. Other one is FFIN. And you guys know Lakeland. I've talked about it before. Lakeland Financial. It's down a little bit. FFIN is down 3%, and you got Cullen/Frost. So that's really what's going on here. Is you got 3 stocks plus another one that are trading at 3 times assets. But what I find interesting is Ameriprise, APAM, Ares. Those are investment companies. Blackstone, and Schwab are all trading also 3 times assets or more. And the question is it growth or is it falling asset values? Now, my guess is that you got thousands of people looking at this stock. You got a huge thing. But truthfully, you got nothing. You got 141 impressions. You got 1 engagement. One person looked at the detail. So, but I think this is fascinating because there are pockets of high valuations out there that have a chance to come down. All right. Quickly look at interest rates again. 3.8, 4.65. That's really low. Yeah, you've got the longs, the 30s and the 10s are up now. It's 2.4 and 1.8 basis point. You got the 5, 2.4 basis points down. You got the 2-year down 8.3 basis points. Somebody is buying up 2-year debt. They just want to put their money away for 2 years. They're afraid. Maybe they just want to stay out. Biden is in. They want to stay out. That's fine. Just so fascinated. It's a lot of money moving. If you can move something down 8 basis points for a 2-year bond, that's a big move. People are making big moves. And look at the dollar, right? Dollar's up slightly. That could have been foreign money coming in, buying dollars, let's say selling yen or selling renminbi or selling the euro, buying the dollar, putting their money into short, very short money, because they know 4%, I'm good, right? I mean, you could tie your money up for 1 year, which is more my time horizon, right? So 4.65, you're feeling pretty good. But if you can earn 4.1 for 2 years, you're probably feeling pretty good as well. Wrap it up. I think that's what's happening. So I'm going to close by doing a little bit of work, letting you guys watch. We're actually going to look at the picks, the model picks. Why not, right? Do some work together. I got to work anyway. So we already talked about you could buy it $100. I mean, come on, that's so cheap. So cheap. I may not do it for very long, so you probably want to get in a few orders now because it's crazy talk. So these are the up runs. Here's the down run. So let's take a look. Let's move this over. It's kind of hard to see anyway. All right, got the up and the down run. So what do? We actually give you guys a lot of information. So let's start with negative beta stocks. And this is through yesterday. So you would have had this information this morning before the market opened. So it's through December 15th. Do we have any negative beta stocks? That's a good question. I don't know if we do. We do have some negative beta stocks. Wow. Yeah, there's a lot. So let's get in. Oh, not all these are negative. Some of these are actually positive, but just high. So let's dig in there. So not the positive ones. Those are actually, we were now removed from our model because they're just too high. They're too risky and they actually overpower the model at times. Here we go. So what's interesting about this is these, with the exception of Chesapeake Utilities, which may or may not be an issue, which may or may not just be like a typo. You just have Chesapeake Utilities. Everything else is synthetic. It's an ETF. We look at the down run. This This is the down run. We look for negative beta. So I'm always very interested that the negative beta stocks, Berkshire Hathaway, Invivid, and Veru. These are not names that I know very well, right? This is not like very interesting. So there you go. I'll start off with negative beta stocks. We got more we can do. I want to thank you for watching. If you liked the video, please hit the like button, thumbs up, leave a comment. Tell me what you like, what you didn't like. Maybe subscribe to the channel. That really helps us. We don't make any money, but it helps. And you spread the message. Maybe drop a tweet or share the link somewhere. And say, hey, I really like the video. If you want to learn about monetary policy, stocks, volatility, trading, ways to evaluate stocks, this could be interesting. Real core data. So thanks again for watching. You guys take care. Market closes not that long from now. So good luck. Never gamble more than you can afford to lose. Be very safe with your money and watch who your custodians are. We don't take custody of your assets. We let Charles Schwab do it. Personally, I trust them more than I trust my own accounting system. So we'll let Schwab send out the statements and all that. What do they get in return? They get to make the trades. So they get the money off the money off the spreads. And they probably get a little bit on the custodianship, so it's not much though. And they do a good job, so why not? All right, they manage like $4 trillion of money. All right, take care, guys. Bye-bye now.